In this week's video, we'll cover how we plan to use the good, the bad, and the ugly to manage investment risk in the coming weeks. We'll segregate the charts this week into the good, charts that still call for some patience, the bad, charts telling us to keep an open mind about corrective activity, and the ugly, charts that have already broken down. We'll also talk about why price matters even in a low conviction market. To view the video in full screen mode, use this icon in the lower right hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right hand corner of your video player. For those of you new to the fold, we'll cover this concept once and then show numerous charts that we can apply the same concepts to. This is the weekly S&P 500 chart. We use moving averages to help us discern between volatility to ignore, volatility to ignore, volatility to ignore, and volatility to respect that requires some type of defensive action. A full bore bullish look telling us that the probability of good things happening is in our favor is when price is above both the moving averages, blue and red. Blue is above red and the slopes are up. The mirror image of that is a full bore bearish look. The probability of bad things happening increases when you get that bearish look. This is part of the good. Why? The present day look of the S&P 500 is still maintaining a tentative but full bore bullish look. Why is this good? Because price has not broken down yet. It's mathematically impossible for the most part to have a multiple week or multiple month correction with a look like this. Eventually this look will morph into something like this, telling us that the probability of bad things happening has increased. The concepts from the previous chart apply to these charts and almost every chart that will follow. This is the same weekly S&P 500. You can see here still a full bore bullish look. It's tentative, but still bullish. This is would I rather be long, would I rather be short? Again, it's mathematically impossible to have a serious correction when this chart looks like this, especially a multi-week or multi-month correction. This calls for some patience. Would I rather be in stocks or would I rather be in bonds? Indecisive, but still has a full bore bullish look. Now, why would we be patient when we still have these looks? This chart looks noisy and confusing, but it's not. If we look at things in isolation, it's easy to understand. We're basically looking at short versus long here in this ratio. The rationale being that when we get a full bore bullish look in favor of being short, the probability of bad things happening in the stock market, this is the S&P 500 here, increase. Full bore bullish look, probability of bad things happening increases. Why are we patient with the present day market and why do we still have exposure to stocks? We've been talking about indecisive looks and low conviction markets for weeks now. This is 2013. This is an indecisive, low conviction market for short versus long. We get the sideways look. Nothing says that we have to get a bearish resolution. You can see this consolidation period resolved itself here in 2013 in favor of being long. We broke out of the box to the downside, meaning HDGE was weaker than the S&P 500. And after we broke out of the consolidation period, the stock market here, the S&P 500 in black, went up. So this tells us that indecisiveness can be followed by bullish outcomes, and we need to pay attention with an open mind. Same chart, we're just looking at a daily version. It's a little clearer to see. Why do we not anticipate what will happen during a consolidation period? Or why have we not sold all of our stocks since we're in an indecisive market? Well, this is why. because if we get out of the stock market and anticipate what will happen, in 2013 we had a long sideways indecisive consolidation period we just talked about, and the stock market gained 6.9% after the bullish breakout. Therefore, being patient and waiting for price to confirm, price is king, which way we're going here is very, very important. Here, the breakout started from 1578. Did we eventually give it all back? Yes, we did. This is the taper tantrum here. This breakout starts at 1578. Eventually, we go back to 1560. However, this is a multi-week move here of 7% that we don't want to miss. Moral of this story, we need to wait to see which way we break out of all these consolidation boxes and adjust accordingly. This is the present day consolidation, indecisiveness. We don't know which way it will break. We don't have to know. We just need to pay attention with an open mind and remain flexible. The following charts all fall under the good category. Some CCM clients own the equal weight RSP ETF. You can see it still has a decent looking trend relative to the S&P 500. Depending upon your risk tolerance and when you came on board, some CCM clients own IYT or the transportation ETF, and you can see it was up over 0.5% relative to the S&P 500 last week. This is still a full-bore bullish look that calls for some patience. If the market resolves itself to the upside, something that's been on our watch list for some time are REITs. You can see REITs, or the ICF security, has been trending versus the S&P 500. If we go to full-bore risk off, we would expect this to underperform something like TLT. We'll file emerging markets under the good because for the most part EEM versus the S&P 500 is holding up relatively well. However, sometimes when you see a bullish turn like this, weakness in the S&P 500 can follow. You can also get a bullish turn here with somewhat of a sideways indecisive look. Another takeaway here and why we have a broad and all-encompassing model, if you just blindly follow a relative chart. So here, emerging markets are outperforming and you'd rather be there. However, notice during this period here, both the S&P 500 drops and EEM loses money. So it's a better place to be, but it's not necessarily the best place to be when you see a chart look like this. You just included EEM in the good category. Now you're showing it to us in the bad category. What's going on? Well, EEM, 17% of it is made up of China. So it's difficult, or there's a drag on EEM when China is weak. You can see Hong Kong here underperformed the S&P 500 significantly last week and has a kind of an ugly look to it here on a relative basis. The FXI China ETF is in a full-bore bearish look, telling us that China is a negative drag currently on the emerging markets ETF. Continuing on with the bad theme, regional banks KRE relative to the S&P 500. Support, 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 broken support, and currently has a full-bore bearish look. This is high beta or economically sensitive cyclical stocks, SPHB, relative to the S&P 500. This is what I'm confident about future economic outcomes looks like. And you can see over the last few months, this is starting to look very indecisive. We would prefer this look here to morph into something more like this. This chart here helps us answer two questions. This is defensive bonds, or TLT, relative to the S&P 500. This is a full-bore risk-on look favoring stocks. You can see here we still have price above blue and blue above red in favor of treasuries. So it's one of the reasons why we have some bond exposure in our portfolios. It also tells us that defensive assets have been gaining traction in recent months. This is not what bullish economic conviction looks like. We've got XLP, or defensive consumer staple stocks, breaking out and maintaining a full-bore bullish look relative to the S&P 500 index. Now we're looking at risk off versus risk on, the aggregate bond market, AGG, relative to the S&P 500. This slope here tells us that fear is increasing as bonds are gaining traction relative to the S&P 500. This helped foreshadow this waterfall decline in the S&P 500 in black here. Fear is increasing, stocks drop. Fear is increasing, stocks drop. This is what economic conviction looks like. You can see in 2013 it favored stocks. This slope now in 2014 looks quite a bit different than the slope in 2013. We would call this anecdotal evidence. Why? We haven't done significant backtesting to test this anecdotal theory, but typically when Germany in the recent past has been outperforming the S&P 500, that's been a good thing. This is EWG outperforming for a long period of time, and the S&P 500 does well. EWG breaks down, full bore bearish look. Bad things continue to happen in stocks. We get a breakdown here. Stocks go sideways and eventually drop below that level. Here, probability of bad things happening increases. Stocks drop. Get a bearish look here. Stocks drop. There is an exception. Here in 2013, stocks did well. Right now, EWG looks awful tentative relative to the S&P 500, and from an anecdotal perspective, that's concerning. One thing the market model does, it helps us avoid weak ETFs. This is internet stocks relative to the S&P 500. Former leaders in the bull market, support, broken support with a full bore bearish look relative to the S&P 500 index. IBB has been a leader. Now it's a laggard with a full bore bearish look. Are investors currently confident that housing will help lead us to the economic promised land? The answer is no, according to this chart. This is ITB, home construction, relative to the S&P 500, maintaining a full bore bearish look. The triple Qs, a former leader, now a laggard with a full bore bearish look relative to the S&P 500 index. This is small caps relative to the S&P 500, 2.5-year base bullish breakout. Now it has a full bore bearish look. A former leader is now a laggard. How do we handle this? Well, we've reduced our exposure to stocks. We've increased our exposure to cash and bonds. We'll let the market guide us from here. Remember, the major indices in the three charts that we showed at the beginning of this video have to break down to confirm all this, but this doesn't look good either. Consumer discretionary relative to the S&P 500 index. Former leader, now a laggard with a full bore bearish look. Support, broken support. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.